Hi everyone, welcome to today's video. So on today's video, I'm going to analyze 3 blue chip stocks or rather market leader stocks. These stocks are market leaders. They have given massive run-ups in the past. Right now, some of these stocks are trading at their 12-month low. So given the fact that markets have started to recover, they have started to consolidate, might be a great time to start considering or analyzing some of these stocks. Also, a very quick disclaimer, this is not an investment advice. In fact, on this video, I'm not even going to say what I'm buying, what I'm not buying. You can understand it through my tone. So I will leave that judgment up to you. You can definitely use this video as a research. Also, a big shout out to our sponsors for today, which is Smallcase. They present thematic investment options, and if you are considering a blue chip theme, then it might get difficult for you to pick individual stocks. So I'm linking 2 of my favorite blue chip small cases that you can consider checking in the description box. So let us get the discussion started, and first and foremost, let me give you a very brief commentary on where Nifty currently stands as of today, which is 19th July 2022. So here is a very interesting data point that the markets almost consolidated 1 year ago, and since then the markets have been in constant volatility. They have been going up, down, etc., but they have not consolidated yet. Now, why is this such an important point? For 2 reasons. One is that because markets are volatile, a lot of weak investors have quit investing and they are out of the market, which is great news for good investors who actually research stuff, put their money, are okay with the volatility. So that's one. The second key point has to do with the law of averages. In simple words, it means that since markets have not consolidated for almost a year now, it is much more likely now that markets will start consolidating. So whatever action that we are seeing in terms of everyday volatility, that is likely to come down. And that is precisely what is happening, that markets right now have become relatively stable. I'm not saying that markets are not going to fall. They might very well fall, but the likelihood of consolidation and the markets bottoming out is very, very high right now. Now, with that viewpoint in mind, please consider one more fact about Nifty. If you consider from its peak, then the markets are still down by roughly 12.5%. So there is a lot of gain to be made still, because that price point has already been set, and it is almost inevitable that one day the market is going to cut its previous peak. So even if you do simple Nifty investing, or if you simply invest in blue chip companies, there is a lot of gain to be made, provided that you are patient, you are sensible, and you're not expecting returns from tomorrow. So with that perspective in mind, let us start analyzing key opportunities. First is TCS. I have already spoken about it extensively on some of my previous videos, so I will keep this discussion really short, because TCS right now has started to give a little bit of breakout, and the entire IT sector has started to give a little bit of breakout. So let us understand why the breakout in the IT sector is happening first and foremost. So this we can understand through the PE chart of any IT sector stock. So let us pick TCS only. So here you can see that before 2020, this stock used to trade at roughly a PE of 26-27. Right now, it is trading at around 29. So there is not a huge difference in PE. And if you check that where the PE went to all the way up, so it went up to 37-38. That is when the prices of TCS also peaked, and now it has started to come down quite considerably. Now, why am I telling you this PE story? Am I a big believer in PE? The answer is no. But when you are comparing historic PE of a stock, that still becomes a relevant measure. Now, what happens in a sector rotation is fairly simple, that the PE gets re-rated. Now, what do I mean by PE re-rating? So you can clearly see that in 2020-ish, before the COVID crisis happened, the PE used to be 25 for a stock like TCS. Then it fell because the entire markets fell. Then it started to rise, and the PE went up all the way till 37, and then it consolidated in a certain range. And that PE consolidation stayed active for almost 8 to 12 months, right? So this was the previous PE of the stock, and this was the PE re-rating zone, right? Now, what is happening? That the PE is falling now, and it will consolidate at some point. For example, if the market consolidates at this point, then PE re-rating will happen, and the IT sector stocks will consolidate as per a certain PE. So I hope that viewpoint is clear. Now let us start delving into TCS. Now people are saying a lot of negative things about TCS. So let me take you through that point systematically. So first thing is regarding the attrition rate in the IT industry. So attrition simply means that how many people are quitting their job from IT industry / getting fired. So here you can check a lot of major IT companies are undergoing severe attrition. So this has been a problem. Now big operators will keep on highlighting these type of things in the news media outlet all day long, and they will bring down the stock price of even good stocks. And that is precisely what is happening with TCS. Because think about it this way, that okay fine, people are leaving job, but is TCS struggling or other IT companies struggling in order to fill those vacancies? So here are the hiring numbers for 2021 and projected numbers for 2022. And you can clearly see that there is almost 2x growth in terms of people who are getting hired. Now, had it been the case that India becomes like Japan, that very few people actually are getting into the workforce because the population is aging, no such problem is happening in India. Or had been the case that IT companies are struggling to fill vacancies, it would have been a trouble. But right now there is no such problem happening, and this problem is not going to create any impact on the business of IT companies. So yes, this makes great news material that so many people are leaving jobs, attrition problem, this problem, that problem. But honestly, this is not the reason for the fall of IT sector stocks. Number 2 point, people are saying that, global businesses are slowing down and a lot of problems are happening in the US. Majority of the clients that TCS gets, it's from US, Europe, international locations. So definitely TCS's business will also get impacted. So what I did was that I looked at the contract value that TCS is able to retain and who are its major clients. So of course they don't disclose who their major clients are. So news media outlets do this digging and they are able to figure out the names. And you can check this snippet here, and this is a very interesting snippet. Now what it says is that in around 2015, TCS big client portfolio. So big client means that clients that are giving more than $100 million worth of contract to TCS, that number used to be 24. Right now that number is somewhere around 48. So in the last 5-6 years, TCS has been able to grow its big client portfolio by almost 2x, which is a great growth rate for big business clients. Now, these big businesses are having a glitch in their business as of now due to global recessionary crisis. These are clients like Bank of America. These are clients like Deutsche Bank. Do you think that these banks will go away because of some global pandemic is happening right now? No. If they did not go away in 2008 crisis, they are not going to go away as of now. So they will continue to give business to TCS. Now the question comes, why would they do it? The reason is very simple, that these banks require a lot of back-end infrastructure help. Now TCS does that at a very low cost to them. So they are helping them save a lot of cost and money. And these clients actually depend on TCS in an integral way. So at least in the mid-term, TCS is unlikely to lose any business. It will continue to perform strongly. That is my sense. On top of that, here is the chart for USD and INR, and you can clearly see that INR is getting weakened by every year and it falls by roughly 4 to 5%. Now TCS makes most of its money in the US dollar. So anyways, what is happening is that TCS is benefiting by a 4 to 5% fall of INR every single year. Now you might say that, okay, rupee settlement system has started by RBI. That is going to solve a lot of issues. Okay, I've done a separate video. You can go check it here. So now comes the final point, that does that mean that TCS has no risk? And can I sell my house and invest all my money in TCS? The answer is no. Of course, there are risks. One of the key risks with a stock like TCS is the consolidation part of the equation. So as we were discussing earlier, that the IT stocks have not started consolidating yet. Their PE is still yet to be consolidated, so to say. And same thing has happened with every single IT stock in the past. So let me help you understand this point by talking about the price history of TCS. So you can clearly see that this was a very big period, approximately 3 years, where the TCS stock consolidated. This again was roughly a 2-year period when TCS stock consolidated. This is almost a 1-year period when TCS stock, one could say, is consolidating. So TCS undergoes significant time correction. So it might very well happen that you buy TCS now and for the next 6-8 months, TCS stock does not move much. So that is the primary problem with TCS stock as of now. But the counter argument is this, that if you check the price history of TCS here, right, very recent high that it has made. So it has gone up to a 4,000 rupee level almost. And right now it is trading at a 3,000 rupee level. So how much is the discount by? So TCS right now is trading at a discount of roughly 25-26%. And even if a consolidation happens, my sense is that TCS will start running between this 4,000 zone to 3,000 zone. So this is the zone in which consolidation will happen. So please build your buying or selling strategy accordingly. But yes, if the video gets 15,000 likes, then I'm going to talk about how to trade in TCS stock, not how to invest, but to trade. Today I'm talking about investing. Now let's move on to the second stock, which is Deepak Nitrite. Now Deepak Nitrite has been one of the multi-bagger stocks from last year. Why is it a multi-bagger stock? So let us look at the stock performance first. So you can categorically see that Deepak Nitrite before pandemic used to trade at 300-350 levels. It went all the way up to 2,436 by October of 2021, and since then it has fallen to roughly 1722. So a lot of volatility associated with this stock. Very interesting story. If you want, I'll make a detailed video on Deepak Nitrite, but here are my main bullet points that I want to share with you. So first and foremost, interestingly, Deepak Nitrite, people think is a specialty chemicals business, but it is not. So here is the operating profit breakup, and you can see that Deepak Nitrite approximately make 56% of its profit from phenolics, which is not specialty chemicals. The specialty chemical verticals only gives 16.76% of Deepak Nitrite's profit. But in the last 1.5 years, the narrative has been built that Deepak Nitrite is a specialty chemicals business. It unfortunately or fortunately is not. Now, if you take a look at this snippet, what you will figure out is that when Deepak Nitrite stock gave a run up, it happened primarily because of its phenolics business, which is not a specialty chemicals business. So phenolics are generic products. These are not specialty chemicals. And the revenues of phenolics grew by almost 2 times within a single year. So that is a very high run up in a particular segment where Deepak Nitrite is generating most of its revenues and profits. There is a reason why I'm telling you and stressing on this difference between specialty chemicals and non-specialty chemicals. Now, what happened last year was very simple, that there was a lot of news that was run up that, you know what, specialty chemicals is the next big thing. Every commentator was talking about Deepak Nitrite is the best specialty chemical stock. It does not even make much money from specialty chemicals. So under the garb of specialty chemicals, Deepak Nitrite stock was pumped a lot. Now, can I show you proof that it was pumped? I'm not saying it with a malintent. I'm just simply saying that sometimes these narratives are built, news is run, and retail investors get trapped. So I will show it to you by taking you through the investment holding of Deepak Nitrite. So what you will see is that if you analyze the shareholding pattern of Deepak Nitrite, you will see that FIIs at one point in time used to own approximately 12-13%. They have brought down their holding to 9%. Similarly, DIIs used to own approximately 13%. They have brought down their holding to 10.72%. And when have they cut their majority of the stocks? In the last 3 quarters. And why did that happen? So let me analyze some news articles for you. So you can categorically see from this particular news article that Deepak Nitrite is set to give 135% rally in 6 months. So this type of news was coming in June of last year. So let us analyze what happened in June last year to almost November, December of 2021. So this is June and the stock was trading at 1926 and it went all the way approximately to 2200. So the most powerful run up came actually in these 6 months when the entire narrative of specialty chemicals being the next big thing was run up in the market. Now these type of news are run in the market because there are temporary macroeconomic factors that are at play which benefit the stock. So Deepak Nitrite type of stock actually benefited a lot through macroeconomics, and here is a snippet to prove that point. So last year, due to supply chain disruptions and global pandemic, the phenol acetone imports got hit in Indian market. And Deepak Nitrite holds the biggest manufacturing plant of phenol acetone, and they were able to provide and fill in for that supply. On top of that, there was import substitution, Atmanirbhar Bharat, etc. Due to which a company like Deepak Nitrite started to optimize its utilization base and started manufacturing chemicals at scale, and they were utilizing almost more than 100% of their capacity, as can be seen from this snippet. So you can categorically see that they were backed by higher average capacity utilization of 117%. How 117%? They might have borrowed some capacity from some other manufacturers also. Therefore, it says 117%, not 100%. Under normal circumstances, even in the best of circumstances, the factory utilization is usually not more than 80%. So the point that I'm trying to drive home through this brief story is very simple, that number one, the specialty chemicals narrative is over. FIIs and DIIs have overcome the first leg of growth. They have sold their equity. Third key point, majority of the growth of Deepak Nitrite even going forward will come from phenolics business that has already run at its maximum capacity. Now comes the natural question that, okay, hey, if I have invested in this stock, I have not booked profit, I'm stuck in this stock, is it going to fall further? What is going to happen on the stock? Is it a bad company? So the short answer is no, it is not a bad company at all. Are the valuations very high? No one can tell you whether Deepak Nitrite's valuations are very high or not. Number three, in order for this stock to give a run up, there needs to be some growth area within the firm. So right now that is definitely not phenolics, because that business has been explored quite extensively. That is definitely factored into the price. Now it is approximated that their specialty chemicals business will grow because they are forging newer and newer partnerships, bringing more specialized manufacturers, especially foreign manufacturers, into their ecosystem so they can amp up their specialty chemicals game and make that vertical grow. Now, is there data that their specialty chemicals business is growing very fast? Unfortunately, no, their specialty chemicals business is not growing that fast. Here is a chart to prove it. This is from their latest conference call that the growth rate of their specialty chemicals business was around 10%. Now it's definitely not like a rocket type of a growth. So what should you be doing? Should you be buying Deepak Nitrite, not buying Deepak Nitrite? So let me just take you to the pricing chart and give you some commentary. So you can clearly see that the stock has fallen from approximately 2900 all the way to 1722. So a large correction has already happened. But the problem is that the stock is not consolidating as of now. So will I be taking a fresh entry into the stock? I will leave it to your imagination. I will not give you a clear answer. You would have already understood my viewpoint, but I would definitely advise people taking big positions in this stock to just wait a little bit, let the stock consolidate and then make a call. So before we move on to the next stock, let me give you a final snippet about Deepak Nitrite, about its short-term prospects. One of the viewpoints about Deepak Nitrite right now is that it is logged into long-term contracts with its clients. Now, these long-term contracts are fixed on a certain price. Now, unfortunately, since last year, the input prices for any type of manufacturer has gone up. But what has happened is that these long-term contracts are still being executed at those same basic prices. But now what is happening in the economy is that the input prices are going down. So they might be able to unlock some of the profit margins there. And due to that fact, the price of the stock will go up. Do I believe in that theory? You can understand it from my tone. Now let us move on to the third stock, which is a very interesting stock. And it again was a multi-bagger stock last year. Which stock am I talking about? I am talking about ADANI Transmission. So let me first and foremost show you the stock price growth of ADANI Transmission, and then I will speak about the business. So here is ADANI Transmission business that at one point in time, up until last year, it was trading at roughly 246 rupees. And now it is trading at almost 3000 rupees. So there has been exponential growth in the stock of ADANI Transmission. Now, why is that the case? Is that a legitimate case? Should you consider investing? Let us start having a little bit of discussion around it. So first and foremost, you must understand in what type of business ADANI Transmission is in. So ADANI Transmission is in the business of electricity transmission and distribution. And they make approximately 70% of their profits from transmission business. And if you understand even the basics of transmission business, here is a video that I had done on power transmission companies. So you can go and check it out and develop a more fundamental understanding of this industry. But back to transmission business, one of the core things that anyone can understand is that this is a capital hungry business. You require insane amount of capital in order to run such a business. So let us look at how the company is doing financially. So first and foremost, you must understand the debt to equity. It has a debt of almost 4.3x times. So for every 1 rupee of equity in the company, there is a debt of 4.5 rupees. This is insane amount of debt. This is one of the most highly debted companies in India. On top of that, if you look at pledged percentage, so pledged percentage means that even some part of promoters' equity is kept with borrowers in order to raise money for this firm. On top of that, they have sold some of their equity in order to raise money. So whom have they sold it to? Let me show you a brief snippet. So in FY20, the company sold 25.1% stake in AEML for 3200 crores. To Qatar Investment Authority. On top of that, they have raised $2.3 billion from the bond market. So what am I trying to say? Is it a good thing to raise so much money through equity, bond financing, pledged promoter financing, whatnot? So is it a good thing? Is it a bad thing? I'm not going to comment is it a good thing or a bad thing, but this is a highly dangerous game. The stock, because it is using so much leverage. So leverage means that you are working on borrowed money. You might have seen that some traders borrow like 1 crore, are able to turn that into 10 crore. Great bet. But sometimes they borrow 1 crore, lose everything, and they just literally come on road. So the problem is that this leveraged games is high risk, high reward game. Should you be playing it? I will leave that call up to you and guess in the comments whether I will be playing this game or not. So this is the negative side, and you might become a little bit sad that, hey, I was hoping to invest in like ADANI Transmission. Don't worry, I will talk about one stock of ADANI that you could consider investing in case you are an ADANI fan. So you could consider rather that stock. But let me give you some positive commentary also. That there is a reason why this stock can go even higher from the point where it stands right now. Why? Because number one, if you analyze the holding of the company, what you will see is that FIIs and DIIs are very, very interested in this stock. So you can clearly see that FIIs have very much maintained their holding and DIIs have slightly raised their stake. But you will say that, okay, Akshat, this is like almost similar. The holdings have hardly changed. So why are you so bullish by looking at the investor holding? So in the last 1 year, something substantial has happened in the market. So what happened was that a lot of companies got inflated, their valuations rose quite aggressively, and then they started falling. During this fall, majority of the FIIs and DIIs either sold their stakes or have cut their holding. But such a scenario is not playing out for Adani Transmission despite it giving so much of run up. So which gives you a little bit of confidence that okay, probably they understand, these FIIs, DIIs understand this leveraging game more than retail investors. So some high risk retail investors might like to play this game. But please remember that FIIs and DIIs will quickly cut their holding whenever the market conditions are not aligned, and they will be able to book their profits unless you can play the same game like them and are able to scan their moves. Please do not play this game. The second key advantage of this stock is that the rate at which they have been able to access capital, be it through bond market, equity market, pledge promoter holding, whatever, they have been able to get almost access to infinite amount of capital, which becomes a game changer for a company in transmission space, especially if they are able to handle that business. Third and finally, in power transmission business, the business model is very simple, that hobnob with the government, get contracts and make money. I'm being upfront with you. In 2024, it is very likely who is going to win the election. So yeah, you can guess. What I'm going to do is that I'm going to take a look at election mahal around 2023 end, and then I will take some positions in this stock in case I feel like. So that is my viewpoint. But if you say that, you know what, we want to invest in the Adani group, which is a sensible stock to purchase, then I would rather say that buy something like Adani Enterprise. Why? Because that's a conglomerate based model. They own majority of the Adani group companies. So your risk gets diversified. Now in 2024, if the political party that you're thinking about wins, then of course Adanis are going to benefit from it, and even Adani Enterprises is likely to do it. So please think about investing from that particular stock. And also, this is not a political video, I am simply analyzing the stock. So let me know in the comment box which of these stocks would you consider investing in and why, and which of these stocks would you not invest in and be neutral about. I would love to read your commentary, and I will see you soon.